And because the topic of the panel today is volatility, I just hope we're going to manage to wake up a bit the audience. My name is Andrei Burz. I'm a partner with Deloitte, but I'm also a lawyer. And in a previous life, between 97 and 2000, I was a stockbroker. And I discovered crypto space 2018, and both personally, but also working with clients. I'm absolutely delighted to be here with a very eclectic audience, and I think that's representative for the crypto space, because it's something that used to be for just rebels and bleeding heart libertarians, yeah. And now we're seeing a lot of institutional movement in the industry, in spite, I would say, of what is called the bear market in which we are. But I'm not sure it's correct to say in spite of the volatility, and we're going to talk about that. Maybe an unusual way, I mean, we have from left to side, we have Coinbase, London Stock Exchange, Fireblocks, and Imperium. I would actually ask you guys to introduce yourself, not by reference to where you work today, but what you have done before. James.
Thank you. So before I joined Coinbase, I was at BlackRock for about 11 years, running an institutional sales team there for the liquidity business. But what got me interested in crypto there from the TradFi space was not only the client interest that I saw, but also I was part of the DLT Steerco, and I was project lead on a tokenization project of a money fund that you might have seen was posted on the Onyx platform, and I could see the sort of transformation there. So that's what led me to Coinbase, but I joined Coinbase only 2 months ago, so it's...
Excellent, excellent. So we just checked Coinbase and BlackRock. Great. Yeah. Next. And they keep asking, when is BlackRock coming to digital markets, or digital asset markets? It's here already, guys. Dotun.
Thank you. So my background has been largely in technology. Cut my cloth in the video games industry, spent some time in the capital markets, and then CTO'd 2 consecutive blockchain startups over about 3.5 years prior to joining the LSEG.
Okay, so even, also in this case, it's not just London Stock Exchange sitting with us in the panel. Anna.
Good morning, everyone, and thank you for having me here. So I joined Fireblocks about 1.5 years ago, and before Fireblocks, I used to work at Morgan Stanley, and I work in probably the opposite asset class to crypto assets, which is fixed income. So very low volatility, macroeconomic intensive asset class. And I joined because I was attracted by the growth, the volatility, and the level of innovation in digital assets. And that's been a fantastic journey ever since.
Excellent. So Fireblocks and Morgan Stanley checked. Liviu.
I am a construction and real estate entrepreneur, and I am enthusiastic about crypto. I started in 2017, and now I'm the CEO and co-founder of Imperium.
Right, building an index, right, for the digital assets. Okay, so quite a diverse audience. Just to kick off the discussion, volatility, I mean, a lot of people say digital assets are highly volatile, therefore highly risky, therefore you can lose all your money, therefore be careful and have proper risk management. I think all of them are true. But on the other hand, if you're on the trading side, maybe you'd say, I like a market to be volatile. That's where I have what to trade on, right? How do we position, or how do you guys see the market positioning vis-a-vis volatility in digital assets, in crypto assets in general? I use digital assets because in Europe that seems to be the term that was coined by the regulators. For those of you who are familiar with MiCA, the European regulation that's going to come soon and regulate this space, they speak about digital assets, which includes pretty much everything you can think of in terms of cryptocurrencies, stable coins. There's even a debate whether to include NFTs or not there. So, how do you see the market participants reacting to the current, let's say, volatility of the markets?
Do you want me to start?
Yeah, please.
I think it's well documented that some of the active players, the more systematic funds are doing very well. So they're loving the volatility, and I think they're making huge returns. So I think we see that from a trading perspective. And so, but on the flip side, we see a lot of institutional investors wanting to onboard or engage and get ready and prepared for the future. And I think that sort of broader adoption will then improve volatility. And what do I mean by that? I think there's going to be more products that are going to be out there, more ETPs, more ETFs if regulation allows in the US. And I think more structured products will come to the market, and that in itself will create some more stable volatility, if I want to call it that. So I think that's what we sort of see. We're encouraged by the engagement. I think obviously high volatility does put a pause on some projects, but it hasn't stopped them. So I think they've just slowed down. But everyone is excited to see that sort of level of engagement.
I mean that's very relevant coming from Coinbase, obviously, a crypto exchange, let's call it like that. I don't know if that's the brand you're branding.
Well, for the institutional space, we're more of a prime broker, so we combine the exchange with the custody and everything that goes with that in terms of financing, staking, and lending, etc.
Right. Well, maybe in opposition or not, it's probably just complementary. How would I use the word legacy, but you said you don't like the idea that on the stock exchange would be legacy. Heritage exchange looks into the same topic of volatility.
Yeah, I mean, largely I would agree. I think, volatility from a trading perspective is obviously, it creates lots of opportunities for professional and sophisticated investors who understand how to take advantage of that. But equally, there's risk associated with volatility too, so one needs to manage that carefully. I think on the other side, when we look at some of our clients, some of the larger IBs and institutionals who are looking at this space, obviously there's the investment angle to that, which is obviously it's a slow roll. There are larger considerations when you're a highly regulated entity in terms of getting into this space that maybe prohibit you to move very, very quickly in terms of being able to achieve that. But I think the intent is there, the aspiration is there. You're seeing a lot of movement on some of the fringes around some of these institutions whereby they're looking to offer wealth management solutions on crypto and other services in their kind of private banking divisions too. But I think equally, many of these institutions are looking at sort of public chain technologies as a means to facilitate tokenization. But that's a double-edged sword of volatility too, because in that context, when you're looking at, for example, protocol tokens that are required in order to pay gas fees and in order to facilitate the operations of some of these services, from an integration standpoint, many of these institutions just aren't cut out to be able to deal with that level of volatility from an operational cost perspective. So, there's a lot of work that needs to be done to manage that, again, largely focusing on the risk side. And then I think, on the other side, when we look at, the investment angle, once you start to see some of these institutional flows come into the crypto space, we'll likely see a gradual decline of volatility as the scale of capital starts to increase by probably an order of magnitude or two. So.
Yeah, and to me it's really amazing, as advisor, that you have two sides of the same story that are talked about in the media. If you look at some of very respectable publications, you'd see a lot of what the crypto space would call FUD, right? Basically, it's all a scam, it's all a fraud, it's just pump and dump and so on. On the other hand, you see very serious institutions, and I could make a very, very long list of very serious institutions in the space. I mean, even yesterday I saw a few names. I think BBVA was here and others that are actually more and more involved in the space. So it's like a confrontation, and probably everybody has its own bits of the truth, right? Because on one hand, I mean, market abuse. As I said, I was stockbroker 97 to 2000. I mean, market abuse was not invented, in the crypto space. I mean, let's be serious. Yeah, insider dealing and market manipulation are they probably existed since stock markets existed, and there are a lot associated with these new asset classes and so on, and probably rightfully again, because I don't see any reason why this asset class would be exempted. It's definitely not. But on the other hand, there seems to be more about it. Yeah. Because otherwise, why would very reliable, very solid institutions with a very solid reputation continue to work on entering into this space even today? Yeah, being conscious about all these things. So clearly that's investor demand, because otherwise there probably wouldn't be that much, but it's probably more than that. Now, we talked about dealing with volatility more from a financial risk management perspective, right, and maybe market infrastructure perspective. But usually people associate volatility with risk, as I said. Some, or many actually, associated also with opportunity. But you say volatility, risk, and then a question. Well, two questions, Anna, for you. One is, because if I say risk, besides the volatility risk, I mean, are there any other risks that maybe people who want to take a chance and invest money in this space should consider? And kind of the answer, I guess it's obvious, asking the question to you, to Fireblocks representative, but even more, can I, assuming I would be wanting to use an index, because we also have to come to one of the key points of the today panel, depending on how often that index has to be rebalanced, yeah? Would I still be able in the same time to have my assets in safe custody, depending on the frequency of the rebalancing?
That is a very good question, and we have seen a trend of clients and institutional customers going from cold wallets based on HSM technology and requesting more and more the ability to have best-in-class technology and security when it comes to warm wallets or hot wallets. And I think today the best practice for most of the established financial institutions in crypto and digital assets is MPC. MPC stands for multi-party computation, which is the safest standard these days for protecting digital wallets and signing transactions. And it is a field that Fireblocks helped pioneer. And that is where we are helping a lot of our clients. And when I look at what questions you should be asking your providers when you're looking at the infrastructure that is going to be underpinning your operations, you need to be asking questions about multi-layer security. You need to be asking questions about compliance, about governance, about leveraging international standards or certifications, your SOC 2s, your ISO certifications. And once you have answers to those questions, you will have a full picture of the level of operational excellence that you're looking to achieve in your business that will allow you to build the trust, to launch your index, to build your financial services on top of that best-in-class technology foundation.
Many thanks. And I guess regulation was mentioned also yesterday, and I'm sure even today people will speak about that. For years, people in crypto space said, institutions are coming. Well, guess what? Institutions are coming, but they come hand in hand with regulation, and rightfully so, because they have fiduciary duties to their investors, their supervised entities, and so on. So they're not really comfortable to operate in an unregulated space, which means pretty much all the players in the industry, okay, there could be a lot of differences, whether it's US, it's Europe, and so on, but they will have to be aware about the regulations, and that could mean specific regulations, like in Europe, we're going to see a lot of resemblance between how digital assets are regulated and how capital markets are regulated, how stable coins are regulated, and how are e-money regulated. Yeah, so a lot of, let's say, mirroring existing legislation in different areas. Yeah, but you could see also legislation going towards applicability of MiFID or MiFID type of requirements in terms of what can you recommend to retail investors, and generally speaking, consumer protection regulation. Now, on the other hand, yes, regulation is coming. Yeah, so on one hand, regulation is coming, and I think it's good that it's coming. On one hand, because we want people to be protected from frauds to the extent possible. There's no such thing as perfect enforcement of the law, yeah. But to the extent possible, we should aim for that. On the other hand, the innovation in the crypto asset space clearly outpaced the regulators for many years now. Yeah. So people innovated and launched products of all sorts of types, years before regulators could react or in some countries could even decide which regulator should be in charge. I mean, we're discussing a bit before coming here. And one of the elements of innovation is the idea of allowing investors, whether they're retail or professional investors or institutional, that's maybe a different discussion, but allowing investors to allocate their assets based on an index type of methodology. Even so, we don't have currently an ETF per se, right? So, Liviu, I know this is what you guys are working on, and I'm interested to hear, like, your angle on this. How you guys consider to do that?
Yeah, so when you think about an index, it's a way for you to optimize the returns. Also, if the volatility is, or the market is going up, or also if the market is going down. And it's also a way you can mitigate the risk. So this is very important for the usual crypto investor. And what we are doing here at Imperium, we are launching a set of indices, market cap weighted. And difference between an ETF and an index in crypto is that for any investment, we are really buying the underlying assets. We are giving our users custody with the best player in the crypto space. We want to work with Fireblocks and user infrastructure to build upon it and give the users custody and being very safe for them to use Imperium.
Liviu, don't say openly that you're going to work with Fireblocks. Otherwise, the organizers of European Blockchain Convention will ask for a fee, right? Because they facilitate you guys met here. So keep it discreet.
Yeah, sorry. And yeah, what the index offers, as I said, it's a way to optimize the return and mitigate the risk. So,
okay, I'm gonna challenge you with a question here. Yeah, there's a lot of discussion, and people can observe that currently the entire crypto market is highly correlated with Bitcoin. Well, there are people saying that Bitcoin is highly correlated with S&P 500 or various other types of correlations that people have spoke about. But my question would be, okay, if the altcoins are actually highly correlated with Bitcoin, then why would I bother to use an index? Because I can just put money in Bitcoin, and that's my index of the whole market.
For now, because Bitcoin has a very big dominance in the crypto space, yeah, short term it looks like all the market is following Bitcoin. But my perspective is that with further development of the crypto market and further development of the altcoins, I think at one moment they will separate and they will not follow the way they follow now Bitcoin evolution. Yeah, so this is my perspective about that.
Well, and I think history confirms you. I mean, as they say, history is no guarantee for the future, but there could be similarities, yeah.
I think just on that point, I think you will see more sector-based indices come, the demand for that. And again, that might be led then by regulation in the first instance, providing more stability and confidence, right? And that's how we certainly believe at Coinbase is that we're advocating for more regulation as a result of that, and then we'll see further adoption. Obviously, that gives you security as an investor, but also just gives confidence that you can launch products and then demand different types of indices as a result.
How would you see the sectors, James?
We were talking about this earlier, right? We could even go as far as seeing sectors in NFTs, certainly smart contracts, and just there could be a whole plethora of indices that we're not even thinking about just yet if we go into deep into DeFi and Web3. So look, I think we see that evolution. It's not there yet for sure, but we see certainly a demand coming. I don't know if you've got any comments on that.
Yeah, I mean, happy to add. I mean, this is an area obviously of interest to us. As LSEG, obviously, we own FTSE Russell, and as part of the group, we've done some explorations and actually launched some index products on the crypto space. I think there's lots of room for innovation in this area, and I agree with you. I think the sort of sectorization of indices moving forward will be a kind of clear segmentation of some of the products that will evolve. I think equally, much of the work that we've done has been focused on the kind of reference pricing and really getting that kind of straight. And we've worked really closely with the regulators, both kind of in the US and in the UK and across Europe, to ensure that we've got a really kind of gold standard for reference pricing. And I think that's really core to really driving the evolution of some of these things, largely for institutionals who have very high expectations around how these things are managed and governed. But again, I think, as I said, there's lots of scope for evolution. I suspect there'll be interesting growth in sort of private indices and unlisted, and specifically in the context of blockchain technology. I think there's a lot you can do there fundamentally in terms of providing sort of tokenized private indices that can be transferable and tradable OTC potentially. So we'll see how this all evolves, but yeah.
You certainly need good quality data, that's for sure, and you need to make sure it's from multiple venues that you can trust. So I think that will in itself drive the demand as well.
Well, it just struck me that we're talking volatility, and we have representatives of Coinbase and London Stock Exchange, and I think it was a few days ago where the chair of SEC mentioned, amongst others, that adoption of innovation is a must for the traditional, let's say, financial markets, amongst others, in order to expedite the settlement, right? We have the famous T+2, T+3 settlement, yeah? And, well, the hint is that DLT, broadly, probably blockchain, I mean, the purists make these kind of distinctions, would be part of solving that solution, which would mean, faster settlement. And I'm just thinking, could faster settlement mean, obviously means higher, increased velocity of money, but could also mean increased volatility?
If we're looking at the tradition, this is interesting because we've done some explorations around this specifically. So for context,
because just to complete, if that would translate to the traditional markets, yeah, I mean, it's not just how it happens in the crypto markets, but would
in the traditional markets, yeah. So we entered into the FCA's Innovation Sandbox cohort 5 to deliver a post-trade settlement infrastructure for UK equities. So we tested the infrastructure, we built the infrastructure, we tested the infrastructure. And what was interesting actually as part of those explorations is, there's a lot of narrative in the capital market space around this, specifically this area, post-trade settlement with respect to DLT and how it can solve for providing instant settlement as the holy grail. Now, I think our view is very much that it's not the holy grail. If you look at kind of large cap settlement and listed markets today, it's largely credit driven. And if you look at the advantages that provides for member firms, whereby you can capitalize on opportunities in the market without having to worry about effectively how much assets you have in custody and in depository, and making sure that those assets are available in order to be able to settle your obligations in real time. So I think in that instance, when you look at services that are offered to these clients in terms of prime brokerage solutions, in terms of lending facilities and leverage, equally on the CSD side, there are facilities and credit facilities that are made available to member firms. That actually increases liquidity and velocity of trading in the markets, because it is largely decoupled in terms of trading and settlement in the institutional markets today for the types of assets that we would typically deal with, which again is a very different model to what you see in the crypto markets today in terms of it's a fully consolidated market in terms of post-trade and trading all in a single venue. But yeah, we'll have to see how that evolves. I suspect you'll see innovation in this area where there will be maybe for sort of mid-cap or small-cap instant settlement, or let's say T plus end of day, T+1, etc. But I think having variability in that space, leveraging technologies like blockchain to facilitate that, having real-time position management and position view for member firms largely kind of obviates a lot of the cost around reconciliation, which for large members today is literally in the billions, right? So I think there are significant efficiencies that the technology can bring to bear. But I think there will absolutely be variation in terms of how the kind of settlement windows are managed with respect to that. I don't know that instant settlement is the holy grail across the board.
I think when you look at some of the stresses in the market, when you get high vol, it's around the collateral, right? And if you can move that collateral instantaneously, and if you've got digital cash, be that stablecoin or something else, then that does create efficiencies in terms of being able to reconcile very quickly in a sort of highly stressed market. So I think maybe that then does stop all the sort of increased margining with finger in the air percentages, and you can become a lot more dynamic with that. So I think that for me would actually help when you've got real stressed moments, but that's not always the case. That's not always what's driving volatility.
I will agree with that. And we'll also add that there is a huge amount of conversations right now with all the traditional financial institutions coming into the crypto space and helping define the new standards. It's really instant settlement, the holy grail, probably, no? Do you want to be settling once a day, twice a day? What is the standard that we want to be moving towards? And I think there's a lot of interesting conversations right now to manage and to create that financial market infrastructure that we will be using in the decades to come.
Yeah, I guess all over the world the institutions are looking for a standard. I wonder if it's going to be one standard or multiple standards. That's to be discussed, because you mentioned Dotun about being part of some sandbox in US.
In the
now,
UK.
In UK, okay. Now in EU, which sadly does not include UK anymore, but in EU we have recently there was legislation passed basically allowing for creation of sandboxes, specifically for utilizing DLT for the purpose of market infrastructure.
The pilot regime, yeah.
Yeah.
It's not yet finalized, but I think they're entering into kind of early stage consultations to really kind of roll that out. So it's preliminary, but yeah, no, it's really interesting. And equally in the UK side, there's exploration to do something similar. So, and I would imagine equally in other jurisdictions too. But I mean, I think ultimately this is about innovation in capital markets fundamentally, right? It's about looking at the existing regulations and rules around settlement, around market infrastructure, and seeing how, in this new world whereby, in the past regulation, it was largely driven or executed through centralization of those controls and those governance mechanisms in order to regulate the markets efficiently, because that was the most efficient way to do it. Today we live in an age whereby these technologies can actually solve for these things without the need for centralized intermediaries. And so the real question is, can you define new market structures and market models whereby many of the protections that are required, the controls and the governance that needs to be in place in these markets can be facilitated by technology and automation. So I think that's really where much of this exploration is going fundamentally. But it will be a slow burn, right? This is going to take decades.
Yeah. Well, for years it's been said, and it's still being said, that blockchain is a, how do they call it, a solution in search for a problem, right? Well, it's I don't know, if that's the case, since if I look both in US and EU and across the world, actually, blockchain definitely stirred up the discussion for a number of very macro, super important things, like CBDCs is one of them, and market infrastructure is clearly the other one. Yeah, and by the way, I think they're interrelated, and there's more to be said. Last question from the entrepreneur's perspective. I mean, you see us talking about institutions and standards and regulations, and how do you guys as entrepreneurs in this space think to position yourself? Because you'll have to interact with all this infrastructure and exchanges and so on.
Yeah, we're very glad that the technology is moving forward, and we know the pace is, I think, the biggest out of all the markets, and we are very happy to be able to cooperate with all these institutional players and all the regulators, because I think this is the right way to move the space further. Yeah, so I embrace it.
Thank you. I think the whole industry embraces it. I haven't really heard many people in the crypto space saying they hate regulations. What people don't want is regulation that kills the industry, yeah? And that is also possible, by the way. So there's a fine balance to be kept there. Look, I'm afraid that the time allocated to our discussion about volatility and indexes and market infrastructure and custody, I mean, these are pretty much the topics we've addressed today, expired. So I'll take the opportunity to thank the panelists. I don't know if there is time for any questions, or if there are questions from the audience.
There must be outside.
They will be outside.
Yeah.
Okay, we talked too much. Thank you everybody for your
attention. Thank you very much. Big applause.